Welcome back, ladies and gentlemen. Indeed, that was a great presentation by Zopper. Of that, we move on to the next panel discussion. Very interesting and very powerful topic. CXO panel, the future of NBFC in India, Vision 2025. And to discuss on this wonderful panel, I have with me a plethora of experts of the same domain from the NBFC sector. So let me introduce, without further delay, our honorable panel members in sequence. Joining first, we have Ajit Kumar, the COO from CreditBee.
Hey,
A
hi
warm
everyone.
welcome to you, Mr. Kumar.
Thanks a lot, Sana.
Joining next, we have Satyam Kumar, the CEO and co-founder of LoanTap.
Hi,
A
good
warm
afternoon.
welcome to you.
Thank you, Sana.
Joining next, we have Anirban Chakraborty, the MD and CEO from TFCI.
Hi.
Welcome to the panel, Mr. Chakraborty. Joining, we have Theo Shankar Tripathi, the MD and CEO from Aadhar Housing Finance.
Afternoon. Thank you, Sana.
A warm welcome to you, Mr. Tripathi.
Thank you. Thank you.
Joining next, we have Sandeep Virkhare, the MD and CEO from ISFC. A warm welcome to you.
Good evening, everyone. Thank you.
Joining next, we have Vikrant Narang, the Deputy CEO from Ambit Finvest. Welcome to the panel, Mr. Narang. And now, ladies and gentlemen, let me introduce you to the moderator
so
of
much,
this
Sana.
panel session,
Good to be here.
Rohit Aswani, VP of Partnership and Alliances from Zopper. A warm welcome to you, Mr. Aswani. So, Mr. Aswani, all over to you, the captain of the ship and the moderator of this panel. I'm looking forward to a fantastic session of all the experts here and, of course, the moderator, Mr. Aswani. I'm sure the panel is in wonderful and able hands. Hope to have a fantastic panel session. So, all the very best panel members, wishing a great success in the panel. Thank you.
Rohit, you are not audible.
Am I audible, sir?
Yes, Rohit.
Yeah,
now
yeah,
you are.
you are audible perfectly.
Fantastic. So thank you so much, Sana, for your kind introduction of our senior panel members. Much appreciated. To all our respected speakers and distinguished guests, a big namaste from all of us at Zopper, and welcome to the Zopper India NBFC Summit 2021. Thank you so much for investing your valuable time with us this afternoon. It is an absolute pleasure for all of us to be here in the company of such an amazing CXO panel. My name is Rohit, and I'm part of Team Zopper. Before we dive into our discussion, I would just like to take a moment and share a brief about our organization as we are in the middle of all the InsurTech action in the NBFC and the BFSI space. We are India's leading InsurTech and providers of a digital insurance infrastructure platform to NBFCs that enables them and all the insurers to offer unique insurance and assurance plans. Our InsurTech as a service product suite and services include bespoke product design and digital activation, customer acquisition, APIs, product suite, claim servicing, customer ownership, analytics, and predictive modeling, including compliance and regulatory modules. We are a full service player covering the whole 9 yards for all the NBFCs, fintechs, digital lending companies, financing companies, and the BFSI players in the country. Please feel free to visit our virtual booth at this conference and also access our digital assets, including our corporate and product decks. We'd be happy to connect at your earliest convenience in the coming days and offer you the best of our services. So without further ado, once again, welcome to all of you. Today, we have an amazing panel to share their thoughts, inputs, and opinions on the central theme of the future of NBFCs in India, Vision 2025. Our goal today is to get multiple perspectives and opinions out from such a diverse panel of senior executives. All of the honorable panelists would be setting the tone for the audience on what lies ahead, what to expect, how the 2025 story looks like, and how you look at things and the trends for the coming years from where you sit at. How you look at things and how does the story look like in this post-COVID world. All of you bring in your rich experience and valuable inputs on the table. So all of the perspectives are going to be good in the end. We have a qualitative mix of prestigious institutions that cover end-to-end NBFC products and services, including housing finance, education finance, tourism finance, personal finance, vehicle finance, MSME finance, new age fintechs, digital lenders, and also bespoke solutions around corporate finance and equity capital markets. We'll be taking a few minutes for each of the panelists to briefly introduce themselves and how they look at and perceive the central theme of this discussion. I will be requesting all the senior executives to draw out some high-level themes and trends we should be thinking about during this discussion. I would now request our honorable panelist, Mr. Sandeep Virkhare, Managing Director and CEO of Indian School Finance Company Limited, to initiate the proceedings with his views on the subject, talking about the evolution of the NBFC industry and the road ahead on the industry structure and segments. Over to you, sir.
Good evening, everyone, and thanks for having me here. It's an interesting panel discussion that we are having. And in this context, I think the best way to start is a evolution of NBFC that we have seen. And fortunately, I have been always a part of that evolution since 94. I remember 87, 90s when NBFCs actually started coming into play, and 90 to 97 is where NBFCs had a huge aggressive growth during that time. But structure of NBFC at that point in time was different. It was more on a lease financing, car lease financing, for example, Anagram, CRB capital markets, Lloyds, many of them are not there in the scene now. And very dark phase of NBFC, I would say, started after demise of CRB, which got first banking license in 94. 97, it got shut down. And from 97 to 2000, 2001, it was the darkest phase for NBFC. But during that time, many NBFCs got registered. Most of the NBFCs were thinking of getting into deposit taking license rather than non-deposit taking license. That's the kind of evolution we have seen. And also in this context, I must mention that by 2005, even best of the names like Shriram Transport Finance or even Bajaj Finance, they were just 1,000 crore AUM NBFCs. And today, both of them boast of more than 1 lakh crore. And that's the kind of growth we have seen in NBFC. So I think NBFC actual evolution started from 2005, when most of the NBFCs, and then we had a segment-specific NBFCs, sector-specific NBFCs, generic NBFCs like Tata Capital, Birla, Reliance also came in. So that's a growth of NBFC from 2005 to 2015, I would say. That's one phase of generic NBFC, sector-specific and segment-specific, plus general NBFC's growth we have seen. And 2015 and beyond, we have seen lots of fintechs coming in. Digitization started taking place. Loan Tap, Satyam is here. He would highlight more on that. And I think from 2020 to 25, that's the kind of evolution we've seen. And 20 to 25, we will see possibly more of a AI, ML-based, fintech-based, digitized NBFC. Lots of banks wrapping up more on digitization. That's the whole evolution, I would say, and going up to 2025.
Absolutely, sir. In fact, during the course of our discussions yesterday and today, a lot of the panel discussions have focused on tech and digital and how they individually would look at their organizational strategy. So indeed, interesting times. digital times, technological times, and a lot of it, how it pans out. We kind of look forward to it, and it'll be great to understand the views and the perspectives of the other panel members as well. Thank you so much, Sandeep sir. I would now request Anirban sir to share his views, his perspectives, and also touch upon some of the models, the investments, the ROIs, and how he looks at the entire piece, and especially the times and the trends to come. Over to you, sir. Sir, can you hear us?
Anirban, I think you're on mute.
Sorry. I'm sorry. Thank you, Rohit. First of all, thank you, Cinex Group, to organize this kind of very exciting seminars with distinguished panelists and distinguished audience. So basically, what Sandeep started the right note, and with Rohit has brought the point. The last 2 days we will be debating. Even I'm getting into the NBFC space little later. So first of all, I just want to say that entire world, entire lifestyle, everything is going to the digital. It's not that only that particular things. So any pattern of service uses wherever the end users connect is there. So we are heading towards a great disruptions next 10 years in every field, not in the specific kind of thing. So NBFC cannot be different from that others. So NBFC is also a big way we are heading towards that digitization and fintech model. I'm coming little later, and all distinguished panelists also discussed who are working on that particularly fintech model. So what I see that I coming to that this one to give the background how the NBFC is panning out in India today. What is our positioning? How, if you were to define the NBFCs, because NBFC is a very, very big wide range. So prima facie, according to me, when we assess it, say we see the universe of NBFC, it is there in India. It's a 6 different category. So if I getting into category wise, one is the housing category of NBFC is a big chunk, whether it's a digital or non-digital, but it's the housing, define it as a housing under the bracket of housing finance NBFC. Second category will be consumer financing NBFC, MSME and auto, consumer MSME and auto. Third category is the gold loans, who are only focused on the gold, against the gold, they're financing to the end users. Fourth is that in the microfinance, that is also another big space and catching up going forward, maybe have a bigger relevance on financing in NBFC space. Fifth and important where we belong to, that is a thematic NBFC, who are basically financing that specific sector-specific NBFC. Say, for example, Tourism Finance Corporation, Power Finance Corporation. You have that again NABARD. You have that HUDCO, that housing finance kind of things. So these are the REC. These are the basically sector-specific. They are basically conceptualized to promote certain sectors, to take the certain sectors to the next league. So that is the one segment of NBFC. And finally, another final one is the diversified NBFC. They are doing mix and match of everything. Like, for example, the JM, Piramal, maybe the earlier the IIFL, Aditya Birla. So they are getting, they are in that space kind of thing. So within this 6 different side of NBFC, if you are getting into 2 vertical, one is the wholesale piece and retail piece. So what we could see that going forward, and now that retail piece is getting huge momentum. The retail NBFC is getting huge momentum, gathering momentum, because there are a couple of reasons. One is that investors, there are a lot of appetite is there in the capital market investors for these sectors, because price to book in these sectors is, they are commanding the huge kind of value. So today kind of price to book range they are getting as compared to wholesale piece, wholesale counterpart is much higher. So interest in this putting money, more capital into this retail-based NBFC is much higher as of now. This is a trend. And why it is so? Because the digital or your fintech application in the retail is much easier as compared to the wholesale. So fintech, you, with the help of analytic, artificial intelligence, machine learning, you can build up a fintech model, because it is a very kind of a very structured financing in terms of, if you have a data, if you have analytic, you can fix out that selection criteria, fix out your funding criteria. It is quite, you can build up a trend based on that. And it will be basically, I think this kind of modeling going to be more than a finance company, it will be IT company going forward. That is the trend probably is going to come, because how better you can use your artificial intelligence, how better you can use your machine learning and data analytic in these sectors, so you can scale it up, because market is huge. India is a huge market space in the retail, and then every income group, every segment, India has a huge representation. So if you have your model right, your IT things right, your technology things platform is right, so your adoption will be going to be high. Because what fintech guys sees, there are two things are very important. Three things I can say. One is what is the TAM, total addressable market. It's a huge addressable market, so there's no question of this one. Second is that what is the disruption you can bring in these sectors. It's a huge opportunity. If you really artificial intelligence and everything, if you put in, you can make it through. Third one, probably for investor, what they want to see in these sectors is the team. So India has a very expert team in every segment. So that's the opportunity and threat for retail NBFC going forward. Investor getting today, they are giving an extremely good price to big group. Not seeing the much on profitability side. Yes, expected ROE could be range of 12 to 15%, but they want to see that what is the adoptions going to be, and what kind of disruptions that technology model is going to be for the retail. But wholesale is a different game. Wholesale is again wholesale is a real threat today. Wholesale big challenge they are facing. That couple of things reasons. One is in wholesale side, if you see that there are two sides of banking. One is the banking and the para-banking side. Banking clients, whether banking clients, they are not an NBFC client in general. The banking clients is basically, it is a commercial lending, it is a name lending basically. Who is your grandparent or parent, what is their parental heritage, based on that financing happen. So basically non-bank finance give you the opportunity of new generation entrepreneur to give into who wants to get in, who doesn't have a history, given the opportunity to create a history. And the people who are in the trouble, means either it's a cash flow mismatch, whether it is a distress situations, they wanted to turn around to the right kind of capital structure, that is for the non-bank positioning is there. But non-bank, there is a big threat is for non-bank NBFC, non-bank finance company, NBFC, in the wholesale side is a credit fund. So credit fund is last 3-4 years in India is in a big way. It was there in the Asia, particularly Far East Asia and the European US market, that they're getting into the India, they're making inroad in India last 3 to 4 years. And credit fund is much more fruitful, because the flexibility is absolute, because they need not to borrow that, raise the fund from the banking system. They have their LPs, so they have their ALM is much more robust than that NBFC ALM, because wholesale NBFC always a big threat of ALM side, because bank is a major lender to NBFC. If their flow is not happening from there, then they'll get stuck. So that's what that is. A credit fund has got an advantage, and they are now there is a late teen players. NBFC is a mid-teen players, but if that gaps comes down, reduced, and then there will be a big threat for the wholesale NBFC going forward, for that existential crisis. Either they have to shift towards the bank, or they have to shift to the credit funds. So unless and until that fundraising side of them would be, they get a clarity. Here again also that asset side, they are comparatively much better than retail. I feel that by my personal this. But the challenge is basically in the ALM side, what they are facing. And investors going to be seen that what is again ROE is very important. Expected ROE is 12 to 15% range. ROA will be around 3 to 3.5%. This one more than that, they will see that what is the provisioning coverage and GNPA level going forward. So that are the things going forward to attract more fund it here. So investors will definitely look at it. So that's my initial sum up of that, both the overall NBFC and where we are in terms of retail and.
Absolutely, sir. In fact, you've touched on very interesting points, and I think taking a cue from your inputs, it will be fantastic to have the inputs of Shankar sir, Managing Director and CEO of Aadhaar Financing. Sir, it will be great to understand your views on some of the challenges that were put forward by Anirban sir, as far as how the NBFC looks like in terms of shaping up in the coming years. And it will be great to understand your views on the regulation piece as well, and especially how things have shaped up in this post-COVID world. Because things have changed a lot, sir. And from the way and from where you sit, how you look at things, it will be good to have your input, sir. Over to you, sir.
Thank you, Rohit, for having me on this panel along with my distinguished speaker. Sandeep and Anirban has touched upon the greater piece of NBFC. In fact, I tell you, the government of India and RBI both have always recognized that NBFC is important institution, not only for the financial inclusion, for reaching to the last mile person. And during over a period of time, the NBFCs have transformed itself to into I think all pervasive. Every field you go, NBFC will find. So their role is important, and their role has to stay irrespective of situation comes, and the regulation and the government has to support it. Just to give a perspective, that NBFC contribution in the total asset of banking system was 12% in 2010, which has increased 25%. This itself manifests that how much regulation has supported. In fact, regulation allowed NBFC to have regulatory arbitrage by a thoughtful decision to enable them to reach out to the part where banking system is not able to reach, which my both the friend speaker has touched upon. And that is the reason the light touch regulation was there. But what is important to know, that when unbridled unbridled growth of any sector in financial system happens with light touch regulation, it can create a havoc. It may cause systemic failure, and any systemic failure is threat to financial system. That is the reason the Reserve Bank of India has gradually evolved its regulation to support and to ensure that the governance factor remains there. Because today, if you see the NBC system, they have a complex wave of interlinkage, not toward asset side but towards liability side. And therefore, the regulation has gradually evolved. 1964, RBI assumed the regulation of NBFCs. 1964 to 1998, then 2006, then 2014, 2019, the regulation kept on evolving. And gradually, when they came in 2006 and 2014, they were doing regulation based on the size of NBFCs, equity available, net of net owned fund, and so many other factors they took. But in 2019, the Reserve Bank of India realized, and 2021 more precisely, that this system needs to be supported for the country's economic growth, but the culture and the control and regulation should be in such a way that they should always work a spare tire for economy. They should not be in a havoc for economy. And after ILFS and DHFL and Altico and Reliance Home, all these failures of the companies, they gave RBI more to think that what to do. Anirban touched ALM. ALM was the major issue in 2019 when the ILFS failure came. Governance was another part, but ALM was the major issue. So then RBI very clearly in between, before they came in 2020 on how the regulation has to be, they addressed couple of issues, that asset liability management has to be, and they increased the bucket. They said that how it has to be there, how the funding sources has to be there. The NBFC's board has to decide that what percentage of short-term fund they will take, because 2018 the same main problem was there. 30-40% CPs they were having. But they regulated and they gave this, and they brought the liquidity coverage ratio concept, that all the NBFCs gradually they have to have at least 1 month high liquid asset to ensure that failure should not happen. And not only that, they brought chief compliance officer has to be there, chief risk officer has to be there, a board committee has to be there for NRC, for the audit committee, and for the risk committee. All those things brought. But more importantly, in 2021, RBI issued a draft guidelines. They decided the regulation has to be the as per scale. And as a scale, when they wanted, they said it should be the baseline NBFCs having 1,000 crore and below AUM. For them, very light touch regulation, 7 times of the leverage they can have, and they need not have the board committee for all those things. They have light touch regulation. Then they brought middle level of NBFC, middle level there. This consists of housing finance companies and all NBFC or deposit taking around 1,000 crore and above. So you see, the RBI allowed the smaller NBFC to thrive. Out of total 9,500 NBFCs, 9,250 are below 1,000 crore AUM. And for them, it's a light touch regulation. But for the middle level and upper level, they wanted to have NBFC, they have not defined, roughly about 50,000 crore AUM. Today, you have 1 lakh and crore AUM, save in NBFC and HFCs, which are much larger than Urban Cooperative Bank and the rural, regional rural bank. So any failure of any big NBFC damage the smaller NBFCs, because big NBFCs again survive. So the whole thought is that the regulation has become so progressive last several years that they take care of the NBFC system very strongly. For the upper layer of NBFC, top layer, they have not defined anybody is there, but upper layer of NBFC, which about 30 odd will come, a strong regulation has to be there like a banking system. And the Reserve Bank of India is now gradually harmonizing the regulation with the banking system, with the NBFC, like NPA norms are changed from 180 days to 90 days. Capital requirement proposed to be 20 crore rupees from 2 crore. So all the great things which Reserve Bank of India is bringing for bringing the agility, resilience, and the strength in NBFC sector, so that the common man can be served and the NBFC can also survive. Now this has given a lot of benefit in terms of pandemic. You remember when pandemic came, you required two things. The pandemic was unprecedented in the last 100 years. You required two things. One, the support to the common man whose income was impacted. His account should not unnecessarily become a defaulted account. Support to the banking system and NBFC systems, they should not unnecessarily have financial stability problem because of the default of the many accounts, and the liquidity requirement was there. The Reserve Bank of India brought TLRTO to support the NBFC sector in such a way that liquidity crunch should not surface and there should be abundant liquidity available. You must have remembered that when they brought 50,000 crore rupees TLRTO first, they divided the certain percentage has to go to the 500 crore and below NBFCs. 500 crore to 5,000, certain percentage has to go. But they did not allow the entire money to be given to the bigger NBFCs. They wanted to protect the smaller NBFCs. Then they gave 50,000 crore rupees, 25% to NABARD, certain 25% of amount to NABARD, to the SIDBI, to the housing finance company for providing special liquidity facility. So this is for liquidity front. Today also, not a single NBFC is having liquidity problem, be it small or be it big. Second thing, the protection of the asset. They brought the scheme for the resolution scheme to take care of that the customer should be given moratorium or one-time restructuring. That was in the first pandemic they brought, and moratorium helped many customers to survive, and thereafter their account were not reported to CIBIL or any bureau. Second, again April, May, when again moratorium, the pandemic came very heavily, the Reserve Bank of India brought another scheme of one-time restructuring so that good customer should not suffer and they could pay when their income comes. So the restructuring and moratorium coupled with those two things, they have helped the sector to survive. Not only sector, NBFC could not get moratorium from the banking system. That is the reason RBI gave them liquidity system available. But today, if you see the proposed regulation for NBFC of 2021 circular, where the base level, middle level they have defined, and other measures taken by RBI are to strengthen the NBFC sector and make them as resilient to serve the economy, and they should become the complementary to the banking system. Two major steps RBI has taken recently. One is the co-lending. That you should have you should always follow asset light model. You should not have asset with you, do co-lending with banking system or bigger NBFC or bigger HFCs. Second, they change the securitization and the loan sale guidelines. Securitization in India is not prevailing. They have liberalized securitization and loan sale guidelines by reducing the minimum holding period and by reducing the MRR period, minimum retention reserve. So Reserve Bank of India brought multiple things along with the governance. The regulation is tightening for those which are much bigger and can sustain the regulation. Regulation is light touch for the smaller NBFCs. That is what the regulatory environment in India is.
Oh, absolutely, sir. In fact, you've touched on the crucial elements in terms of the regulators itself being quite progressive, supportive and absolutely resilient. And as far as the common man is concerned, sir, there have been a ton of other support areas as well, and especially the phygital model wherein India has been kind of progressing quite amazingly. And I'll kind of try and understand, in fact, all of us will try and understand for the audience's sake from Vikrant sir as well, who's been kind of sharing his inputs on the phygital model, a bit of physical, a bit of digital, and also on the MSMEs piece. So Vikrant sir, if you could throw some light on how you look at the entire piece with respect to the phygital piece, the MSMEs piece, and how it is going to kind of shape up in the coming years. It'll be fantastic to have your input, sir.
Thank you, Rohit, and thank you, esteemed colleagues. I think it's been kind of the remarks have been kind of very helpful to set the stage in terms of the overall scene which is playing out in the NBFC space. As I see it, I think few things. If you really look at the roller coaster ride which the sector has gone through over the last 3 years. I mean, 2018, I remember all of us were cruising upwards and onwards. And then came the first bump, which was the IL&FS crisis. And then one after the other, you saw disruption of a negative connotation in terms of DHFL, Yes Bank, etc., etc. I mean, so the sector has gone through a lot, and we were just kind of recovering, I reckon. And I remember 5th March of last year is when the moratorium on Yes Bank was announced. And come 18th or 19th of March is when we got into a full lockdown. So it has been real tumultuous last few years in terms of how the overall economy sector, etc., has played out. I think some of my colleagues mentioned, I think some of the events where a few NBFCs got impacted for a variety of reasons, DHFL, etc., etc., did blemish the sector in some way. I would say that there was some taint which came about in context of how the regulators looked at the sector, how the banks looked at the sector, etc. And it did impact capacity to grow, both from the perspective that the capital availability became from banking side a little bit more suspect, and I think over a period of time that has opened up. And as Mr. Tripathi said, the regulatory environment also, as a consequence, changed. Bringing in a tiered structure for the NBFCs, depending upon the size and the risk rate. But to be giving RBI its credit, I think they during the peak of the crisis, I think the way the central bank acted in terms of providing liquidity support and the regulatory support is just phenomenal. I think that helped the economy to come back. On ground, obviously, the situation, as we saw in terms of our borrowers and everybody, was quite bad. We had to offer a lot of support thanks to, again, the regulatory oversight which was there. But now, looking forward where things are, as I see, and I have some colleagues who have a very strong bias on the digital side as well, the way we are seeing from here on as we go, I think there are, if you look at really the drivers of the NBFC business, you can kind of pretty much put it into 3 parts, right? Part number 1 is your cost of borrowing. Part number 2 is your OPEX ratios, OPEX to AM ratios. And part number 3 is the delinquencies, which are there, right? Obviously, I'm making it very simplistic. But capital availability and availability of debt financing, I think if you have a robust model, I think you will continue to attract capital. Right now, we are at a place, I dare say, the markets are really in a frothy phase right now. So if there's a possibility, people should raise capital, bring in liquidity, as much as one can, because the kind of crisis which we have seen does make, as managers of capital, make us a little conservative, and you want to preserve on liquidity, etc. And in terms of just the OPEX ratio, I think that the digital disruption which is bringing in and we are kind of operating in the market where on a digital perspective, we are obviously building our own technology, but at the same time, we are entering into many partnerships where folks have built up either marketplaces or have access to huge amount of customer data, where there may be a financing need, and that gets passed on, filtered across to us. And using our own credit engine, our own rule engines, our own underwriting processes, we are able to fulfill the capital needs if we can. And obviously, the customer selection and ability to underwrite then shows up in your report card, depending upon the type of product. If you're doing an unsecured loan within 9-10 months, you will know what percentage of your portfolio has got kind of damaged in terms of delinquencies or potential losses which could come through. By that time, you'll start to see some losses kind of showing up. So to my mind, at least the way we are kind of thinking is that as you look at building a kind of a very robust engine, we are dovetailing between both physical and digital built up. So as we call it, as a phygital model in some way. So there is a physical infrastructure which is rolled out. There is a feet on street branch network which is obviously there, and kind of backing that up is a huge layer of tech to make the processes as efficient as possible. And you're bringing about a distinction in terms of the product pool which you're addressing. So there is one end of the market which is secured, obviously, where you will need to collect property documents, you will need to see the level of activity, you will need to see what collateral is being offered. So that cannot get fully digitized, at least in the current scheme of things. You look at different states in India itself, there are different type of properties. There is Lal Dora, there is somewhere the records are fully digitized, somewhere they are not. So there is an element of digitization which you can do, but to a certain extent. And on the other side, you have an unsecured kind of lending, which I think everybody is working to make it as seamless and as digital with zero manual interventions, which is possible to run that strategy in that way. So if you kind of put these two pieces together, I think it feels like that's the way to address the market over a period of time. So that's kind of where the blended approach comes in. But there's no doubt, in my mind at least, that with the heavy capital influx in terms of private equity player, venture capital funding, the tech enterprises, that this story will evolve more and more. The data will get more and more mined. The AI will help creating debt stacks and help with refining the rule engines which we are running in the background to bring about an optimization both in terms of OPEX costs as well as the delinquency costs at one end. And I think that's the way to build a business, because reality is that right now capital is chasing very high promising tech enterprises, but this has to then translate into value creation and value realization for the investors. And should it hit a traffic accident and what you feel is light at end of the tunnel is actually an approaching train, then I think there would be impact in terms of availability and kind of capital which is getting rationed in this direction. So I will pause here.
Well, absolutely, sir. In fact, since you've laid the foundation for the phygital piece and how things have evolved over the recent years, including some of the feet on street and the banking correspondent models, making use of the tech and the physical, I think we also have a lot of spotlight on the fintechs of today as well. And it's fantastic to have Ajit sir and Satyam sir. I'm going to first request Ajit sir to share in his views as to how he looks at the overall fintech piece meets NBFC piece, the kind of strategic alliances in that particular segment, making use of that the data to kind of underwrite better products, to kind of gauge the customer's intent to pay. And I'm sure it's going to be fantastic to have Satyam sir's inputs as well on this entire piece. So Ajit sir, if you could kind of share your views on how this has shaped up in the recent times and how it looks like shaping up in the coming times, it'll be fantastic from your side. Over to you, sir.
Sure. Thanks, Rohit, and thanks a lot to the esteemed panelists. I think from Sandeep sir, who had highlighted about the evolution of NBFCs, to Anirban sir, who had highlighted about the type of NBFCs and regulatory piece highlighted by Shankar sir, and then Vikrant spoke about the regulations. I represent Credit B, and B at Credit B, we have a group company which is a systematic important NBFC registered with RBI. So in terms of how we are looking this entire piece and how we look from there are two or three key themes I look at. One is like the technology as a centerpiece to serve the customer, but it needs to be in cohort with the people you have and the processes you set up. Technology at standalone will not fly. The processes, if you have excellent processes, but now everything is manual, now that will also go outdated. And if you have process and technology, but people who are front ending the customers and people who are still managing the intelligent the dashboards and the other things, then still it will not, at somewhere you will met with an accident. So this, I mean, integrating the using the technologies to cover these aspects is a very crucial part. I think what we as a, I mean, fintech NBFC, there are two or three key pieces we are trying to cover. One is like the, as Vikrant mentioned, that making the entire customer journey as seamless and completely digital. Because what we see is now the, I think how it helps is, it not only helps us in customize our offering, but now the offering is not only the end product. For the current customers, the experience itself is a product. So how we can use the technology to give him a customized journey where I think he feels empowered and he doesn't feel at any point of time that, oh, he is being asked something different. And still, I mean, you are in a business of financial services provider, so you need to validate his KYC, you need to validate his intent, and you need to see how he will perform. So I mean, using technology to serve him the best in class experience and customizing the end product, that is critical. The second piece is that how we can use technology to increase the reach or increase the distribution. I mean, we have fantastic example where I think the banks and NBFC, the MFIs, they have done through the banking correspondence and everything. They have embraced technology where I think technology is used even in most rural India to onboard the customers. I think what we have done one level ahead, that probably doesn't require even one manual touch points, but the same level of information is captured. But it is also important for us to work with the guidelines issued by RBI, where I think the KYC processes needs to be strengthened, and it should ensure that the customers are educated. I mean, the hallmark of the RBI recent regulation is their reinforcement on transparency, as well as on the stringent KYC. Because I think what one of the things in last 1 year, whenever someone has asked about multiple other aspects about NBFC, whether it's about rates or any other things, I think the hallmark has been that the transparency is important. Customers should be notified in advance, and that is a very critical piece here. And then looking at I mean, customer at the as a center in reach, in distribution reach. Then the last piece where the technology is very important for the not only for fintechs, I think now even for the banks, is that how you are managing your portfolio. It's not underwriting is something where the technology came early, I think 10 years back, and now it is very deep, where you have I think at the end, most of the time the assumption is machine will make a better decision rather than setting someone who will approve or reject. And so you have 5 levels, 10 levels, all decisions being done in a fraction of seconds. But now I think the next level of technology will come. Technology will come through the intelligent dashboard managing the portfolio, both from the kind of portfolio you have, the composition you have, and the second is that how you are tracking your delinquent customers. I think now if you look at the number of I mean, in collections itself, how we are I mean, the manual touch point is being reduced. Earlier, I think that manual touch points were responsible for, let's say, 90% of the collection. That has already gone to below 50% of for some of us. And that's one of the metrics we track clearly, that I mean, someone that what percentage of collection doesn't require, what percentage of delinquent customer doesn't require any kind of a manual touch point. Because I mean, these are the pieces which will clearly decide the, I mean, in terms of the NBFCs, how we will prosper and how we can go ahead and how we can grow even further. Because I think disruption is there to, I mean, in every sector, as one of the panelists mentioned, and it will come in here also. But how we are able to customize our product offering and how we are able to embrace disruption will decide us. The second is that we need to be cognizant and compliant with RBI regulation, and ensure that we are doing that in spirit, as well as in terms of the processes we are setting, and how we can use technology to ensure that these things become part of the system, rather than I mean, having any kind of a manual dependency on this. So these are the few items we see clearly, that improving the distribution, putting customer as a center, and how we can have more technology to serve different aspects of the NBFC.
Oh, absolutely, sir. Absolutely. In fact, Satyam, sir, it will be fantastic to have your inputs on how you look at and how you perceive the entire piece. How data, analytics, AI, ML, some of these are big, heavily loaded jargons and terms, but at the end of it, they need to translate into business. So whether an organization, whether it's an NBFC or even if it's a fintech, it turns out to be business in the end. So how do you look at the entire piece, sir? And what do you think are going to be the trends for the coming years, sir? Over to you, sir.
Thank you, Rohit, and thanks to Cinex Group and also Zopper for getting me into a panel which is already loaded with Dev sir, Sandeep sir, Vikrant, Anirban, and Ajit on the same panel. So thanks a lot. It's always a pleasure to listen to each of you. So going forward, so coming last, probably I'll do a bit of spoil sport. I think yeah, the need for NBFC is well established, and both institutional government wise as well as the regulator wise, the need has been identified, established, and lots of enabling has been done in the aftermath of COVID to ensure that NBFC system continues providing the leading solutions to the deserving ecosystem of MSMEs or consumer class equally. Even if we look at the latest of the Niti Aayog reports and all about making electric vehicles available to the masses, 10 points has been identified. Out of that, 6 is only about the lending and making credit available. So, so that's the kind of importance. I think we all have discussed it, and so we'll not deliberate it. What I would want to put across is that what we are seeing is a structural collapse of a traditional retail NBFC. So wholesale NBFC, we see it as a more game of a balance sheet, and where the banks will prevail as a way of because the tool there is to reduce the cost of capital incrementally every passing year, every passing quarter. Retail NBFC has survived essentially on the way of distribution. And when we look at a distribution, whether it's a gold loan distribution, whether it's a MSME distribution and all, so distribution has been the key, and the second has been historical learning on how do we underwrite. So underwriting is always an art, and then we use AI, ML, and all to convert it into a science. But it's first an art which we all have mastered over a period of years. Somebody for 40 years, some of us for 20 years and all. But yeah, we have given that much of a time to adopt to this art. So having said that, it's an art. The credit piece, I would not hazard too much of a guess because credit needs lots and lots of data in a right structure. Unfortunately, the data libraries and all are getting created only in last 3 to 4 years. So the underwriting part of the ML and AI will take another 2 to 3 years to thumpingly establish its position. Right now, you are working in a range. You are working in a range which is giving you a marginally better result than a traditional underwriting of a cash flow based underwriting and all. But another 2 to 3 years, it's what it will change. Now, what we are seeing, as I was saying, on the distribution part of the NBFC strength which we had, the distribution itself has been disrupted across the segment, and distribution is not something which the way we have been looking at of creating a branch, creating an RMDST ecosystem, creating a office outlet and going and doing it. The distribution is getting across the product line, is getting towards something like a super app. It's going on a platform play. It's going to the same customer, doing more and more product. All of us as an NBFC, we have struggled, okay, and we have not sold anything more than insurance product, that too at the time of a loan dispersal as a cross sell. Okay, you go to an Amazon today, Amazon sells 10 products to the same customer. Okay, so it is about two parts. One is getting the customer in. Okay, getting the customer in has to happen across the channel. So the distribution is no longer about a Google advertisement, Facebook and all, but of course, catching a customer in different network. And once you get the customer, then how do you re-engage with him? How do you engage with him? How do you do more and more product rather than being a passive lender where you do a loan, unless until loan defaults, you don't go back to the customer. Okay, so we go back to the customer only when we see a delinquency or only when we see a bounce, right? We do not go otherwise. So this is a very different stance as an institution. Whereas when we look at the stance of an Amazon or a Google Pay or a Paytm or a payment network and all, which thrives on a re-engagement. Okay, and re-engagement for us from the vantage point, what we can see it closest in a payment gateway network and in plastics network, which is the credit card, where you do a multiple re-engagement with the same customer, multiple transaction, multiple product point on the same customers. Okay. So this is where I'm saying the whole system, the way we have imagined is no longer transitional. So the technology, when we started LoanTap 5 years back, as Sandeep sir was actually pointing out, there was a phase between 2015 to 2020, and then now there is a phase between 2020 to 2025 when we saw it as a transition. Okay. Now we are no longer seeing it as a transition; we are actually seeing it as a disruption. Okay, so so when a disruption for some NBFCs, while you will have a capital constraints, at the other side you have a whole lot of capital wanting to do an NBFC. Yeah, so you have a payment network provider, you have some other provider sitting at billions and billions of dollars of valuation and ability to pick up money like this. All they have to do is come in and lend in a regulated fashion. Yeah, so the capital constraint gone. Okay. What you are left is that how do you play with the customer? What we see is sourcing. We see a disruption which has been happening, and we are still seeing only the figment which has happened on the sourcing side of the disruption. At LoanTap itself, we see 60% of our business happening on a partner network, and these partners are not classic DSA partner. Okay, no DSA, no CA, no DST, and that's the partner network that you are running. When you look at the customers in all the fintechs, like whether it's a CreditVee, LoanTap, and all, you will see 80 to 90% are a repeat customer. Okay, you look at a larger peer like a Bajaj Finserv, you get the same number. Okay, whereas each of the NBFC or a bank in a loan business, you only reach about 9 to 10% of a repeat business. Okay, we have done a cross sell, we have had cross sell verticals, and we have tried everything, but the cross sell potential was always limited to an extent. Here you are talking of 80% of a repeat business on a book which is growing month on month about 5 to 7%. The number of loans in fresh acquisition is going. So sourcing, what we have seen is still small, and we are going to see a large changes happening on the sourcing side. Re-engagement, as I say, we see it as a two flywheel, and that's what is powering the fintech revolutions now. One flywheel is about getting the customer in, and the second flywheel is continue re-engaging with the customer, monetizing it, doing more and more product in the same ecosystem. Whether you want to call it a super app, whether you want to call it a flywheel ecosystem or a re-engagement ecosystem, whatever you want to call it, it is essentially staying close to the customer, monitoring what he is buying, what he is liking, and then enabling him that product. Because right on a day one from ICICI system, we have learned that loan is always a pull product. It is not a push product. We are only an enabler. he is buying a product or experience, so we are coming there as a lender. So that's how we have been seeing this ecosystem coming in. As Ajit rightly mentioned about the collection ecosystem, which is a portfolio management ecosystem, where lots of work has happened, the entire arbitration journey and all has already been crashed from 6 to 9 months to about 45 days flat. So that's the kind of a stuff which has happened on the portfolio management ecosystem. Besides the whole payment, with no cash handling and all kind of stuff is already there in the place. And as some of you and mentioned about the co-lending. Co-lending cannot be possible without having a deep tech architecture. All the institutions have a different underwriting structure, different accounting structure, different product parameters. It has to be vetted on a technology. It cannot be vetted on a manual ecosystem. So
Absolutely.
each part that you are seeing a major role of a technology, and that's where I'm saying structures itself will collapse.
Well, absolutely. So, in fact, in the end, you also touched on that co-lending piece, and there's a lot of action in process. And it's not just about the lending piece; it's also about correlated ancillary activities and products, including our industry, which is InsurTech. So there's some action happening at our end as well, and we would love to kind of make use of our stable in terms of retailing your customers as well. So we'll probably have that conversation sometime else. But I think from an overall perspective, from a macro perspective, there's a lot of synergies that are being played out. The future is going to be a lot about these alliances, these partnerships. Tech, as you rightly said, would also go through a particular phase wherein it's tried and tested to work out the best fit for the ecosystem. Overall, a lot of underwriting to make use of these products and how to kind of judge the intent of the end customer is also being worked out. And I think all of you have rightly put it out, rightly summarized. For us, for the Indian ecosystem, I think there's plenty of action and there are a lot of things in the pipeline as well. Before we kind of move towards closing this particular session, sir, if any of the respected speakers would want to have other concluding remarks, you're more than welcome, sir. If there's any trend that you would want to emphasize on as a closing remark from your side, sir, you're more than welcome to share it forward, sir. So Anirban sir, Shankar sir, Vikrant sir, Sandeep sir, Satyam sir, and Ajit sir, thank you so much. If there are closing remarks from your side, sir, you're more than welcome to put it forward.
I would like to say only this thing what my friend Satyam and Ajit has mentioned, that now the transition from the digital to technology is almost over. There is no other way but to live with the digitization, machine learning, AI, and the technology, because digital transformation revolves around the customer experience, and how much you can reach out. You cannot reach out manually because reduction of cost of operation is the key. The collection of loan installment are the key. When you have got a large pool of customer, it is very difficult. If you see in 2000, very few customers were there. Now the customers are the number is quite busting like anything. So this and India has got huge requirement of credit. Still there is huge credit gap, particularly the informal segment. So I think the digital intervention by the NBFCs and fintech company and the partnership with them is going to make Indian economy great. But of course, we need to be respectful of the regulation. We need to be compliant. Gone are the days when people were doing a lot of hanky-panky. Now the regulation is not going to spare them. And with proper regulation and governance, any company can rise to any height. That is what my view.
Oh, absolutely, sir. In sync. And I think some of the other speakers would also replicate your thought process. Sandeep sir, Vikrant sir, Anirban sir, closing remarks from your side, sir.
Yeah, I think all we have spoken is about on a consumer side and digitization. Of course, yes, that's something which is required. But at the same time, if you ask me what else is a missing piece for any economy to grow, consumer side is fine. In fact, there is lots of room to play there. But infrastructure NBFCs is something which I would like to see in Indian context, because if any entrepreneur wants to open the school, no NBFCs there. If any entrepreneur wants to start any project, there is no NBFC or banking or financial institution we have. We had IFCI, IDBI kind of organization, but all those are converted into banks. And I think NBFCs specialized into infrastructure has to be there. And that's how most of the economies in the world has grown. So I think that's a complete missing piece at this point in time.
Absolutely in consensus, sir. Vikrant, your remarks, please.
Yeah, I think it's been very interesting. It's really interesting to hear remarks from everybody. I think both from the perspective of regulatory aspects being now quite tight, and there is ejection of entities which don't follow the line in some way. But one thing I feel, and this is coming more from availability of foreign capital and robustness of the portfolios, and I want to move away for a bit from the digital lending side and everything, is that I think if India is able to strengthen its legal infrastructure, I think that will further ensure availability of incremental capital, resolution rates in this country, which will go a long way in establishing more and more confidence from capital providers, whether it is debt capital providers or equity capital providers. To take it to a place where at some place you are lending to folks basis certain documents without any physical intervention or any physical meetings. And if you kind of superimpose a very strong legal infrastructure where only credible borrowers who are aware that there are legal implications of not adhering to the debt schedules, etc. Obviously, if there are certain circumstances where a business fails, etc., that's okay. But I think that will go a long way in terms of everything which is required in the sector. I think so. If over a period of time one has seen SARFAESI being available to lower ticket sizes, I think just the functioning of courts, which was not happening because of COVID, it has started to come back. We are seeing our recovery rates becoming better as that process is moving and taking forward. I think if one sees a further reinforcement of the legal sort of infrastructure and a legal framework in this country, I think that will add a lot more value to everybody who's doing, building NBFCs in this space today.
Well, in fact, we make use of the last couple of minutes to have the closing remarks from Anirban sir and Satyam sir as well. And we see Sana on the screen. So we'll kind of have her wrap it up towards the end. But Anirban sir, Satyam sir, your closing remarks, please.
I wanted to just summarize.
Anirban, you have two devices open, I think.
Yes.
Hey, thanks, Rohit. In the interest of time, I think I'll just conclude that all the technology and all are only to make the journey for the customer easier. And the second, of course, the transfer pricing is also reducing. So the whole friction which was adding cost to the system for the end consumer, that is also reducing. So we'll see both MSME side of the business and the consumer side of the business even benefiting at a lower cost as far as the loan itself is concerned. So I think the benefit ultimately is going to come to the consumers. That's it.
Yeah,
absolutely agreed.
Thank you so much. I think, Mr. Aswani, we should now conclude it. So indeed, that was a great panel discussion session. Thank you so much, Mr. Aswani, for moderating the panel so well. And thank you so much to all the panel members, Ajit Kumar, Satyam Kumar, Mr. Chakraborty, Mr. Tripathi, Mr. Virkhare, Vikrant Narang. Thank you so much. Fantastic having all of you here on a busy working Friday and for giving time on such an important subject and topic, the future of NBFC in India Vision 2025. Thank you so much to all our viewers and attendees who are watching us live. So I'm sure a lot of takeaways from all these interesting people from such an expert panel like this. Thank you so much once again. And thank you, Mr. Aswani, for doing the honor of moderating. Hope to see all of you in the next edition of India NBFC Summit. Thank you.